The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. I'd like to welcome you to today's webinar, Sales and Use Tax Update, What the South Dakota versus Wayfair Ruling Means to You. We appreciate you taking the time out of your schedule to join us. Just a couple of housekeeping items we'd like to mention before we begin the presentation. All attendees are in listen-only mode. If you have any questions throughout the presentation, please submit them through the GoToWebinar question box. We'll be following up after the presentation to answer any questions. I'd like to introduce today's speaker. Stacy Dozie is a Strategic Alliance Manager for Avalara. She's worked in and around the Microsoft space for over 20 years, doing everything from implementations and training to sales and partner management. So at this point, Stacy, I think we're ready to transition the presentation over to you.
Great, thank you, Rebecca. And I'm going to just check one more time. You can hear me okay?
Yes, we can.
Wonderful, thank you. So again, thank you all for attending. My name is Stacy Dozie, as Rebecca said, and we're going to get into some great sales tax conversation today, which I'm sure everybody is very excited to talk about. So I just want to first talk a little bit about what we're going to discuss in today's call. The agenda looks really small, but there's a lot of big topics in it. So we're going to talk about the challenges of sales tax compliance, which is going to include kind of some of the new stuff around South Dakota v. Wayfair. What is it and why is it important to you? We want to also talk about how automation can help with some of these compliance challenges, and I'll talk a little bit about our ebook at the end of the session, and of course we'll have time for some questions at the end. And as Rebecca said, if you have questions, you can pop them into the question box and we'll answer those at the end. So since it's kind of bright and early for some people and maybe a little bit later in the morning for others, we're going to start out right away with a pop quiz. Now, I do know that you are all muted, so this is kind of just going to be something that you guys can just participate on your own and hopefully you get a little chuckle out of and maybe a little bit of bewilderment as well. But this is something that's really fun when we start talking about sales tax with our customers and partners, because there are a lot of complexities about sales tax, which is what we're going to talk about. But we want to give you some examples right off the bat. So we've got some things here, for example, bagels in New York. This one I think is maybe a little bit easier as far as which ones are taxable and which are not. So a sliced bagel becomes more of a prepared food in New York, so therefore that is taxable, whereas a whole bagel is exempt from sales tax. If we move on to a little bit harder, the takeout beverages in Colorado, with a takeout beverage, the cup is required to carry a beverage out of a restaurant. So that is going to be exempt from sales tax. But the straws and the lids are taxable because you don't actually need those. So those are taxable items in Colorado. And then we move to the candy bars. Now this is really fun. It's in Indiana. I also live in Minnesota. We've tested this here, and this is true in Minnesota as well. And believe it or not, all three of these items are not taxed the same. So I'm going to pop these answers up, and you can see that the Butterfingers is taxable, where the Twix and the Kit Kat are exempt. Now this normally would be where I'd like to invite some discussion, and maybe at the end, if you guys have questions about this, we can certainly go into that. But the idea here is that the Twix and the Kit Kat actually contain flour, which make them more of a food item than just a pure candy item. So also what that means is I'm giving you permission to eat as many Twix and Kit Kats as you like, because they're a food, so you're all good. So let's just go in and talk about some of the complexities of sales tax in general and why compliance is so important. Right now, there's a lot of change going on. There are a lot of things going on in our economy, a lot of sales tax registrations. We'll be talking about the Wayfair. And there's a lot of increasing enforcement of that. So a lot of audits are taking place. States are hiring auditors like crazy. They were hiring some temporary auditors in some states. They've all become permanent employees. A lot of states are sharing audit information with other states. So to companies and businesses, this really means that there's a lot of risk right now. There's risk of being audited. There's risk of not being in compliance because the laws and the rules are changing so quickly. And you have to have somebody that's really on top of all of that and making sure that you are in compliance. So that equals a lot of risk. On top of that, right now our states are currently taking in about 47% of their revenue is coming from transactional sales tax. So that is a lot of money coming into states that they're relying on when it comes to the things for their roads, education, all the things that they want to do in their state. So they're trying to find more ways to increase that pot of money. That's a large percentage of their income coming from transactional sales tax. But lately there have been some things that have really hurt that bucket of money. So if we look, due to some recent studies, states are losing somewhere in the area of $24 billion due to e-commerce sales. Because if you think about how this works, back, years ago when people had local stores, people were shopping local, they were paying tax local, and so everything was staying within their state. They were going down the street and shopping and paying their tax. And now with everybody going online and buying through Amazon or eBay or Wayfair or wherever they're buying their products from, a lot of states are losing revenue. And so that 47% is really shrinking, and they're trying to find ways to get that back. So this really leads into kind of the South Dakota v. Wayfair. I mean, it's not the only reason. There was an original ruling, Quill Corp versus North Dakota. I don't know how familiar some of you guys are with some of this, and I am certainly not a tax expert. But this idea of no longer needing a physical presence, but actually being obligated to collect and remit tax in the state with remote sales has been in play for quite a while. It's been going around our court systems for quite a while. And then on June 21st of this year, the Supreme Court actually ruled in favor of the state of North Dakota. And I'll be honest with you, from what I've heard, some of the larger states like New York and California were really happy that it was a small state like South Dakota that took this cause up, because it gave it a little bit more credence than one of the big dogs. So a little state like South Dakota is saying, listen, this is really hurting us. We really need to collect this sales tax. It's important to our economy. There's no reason that people shouldn't be doing that. So the Supreme Court did finally rule in favor of South Dakota, and so that has been kind of what all of this buzz is about. So kind of who is affected? I'm not going to read all of this verbatim, but this is largely due to remote sellers. Anybody who is currently a remote seller who's registered in South Dakota, there's really no change here. There are some thresholds here. So right now what South Dakota is looking at is if you have annual sales into their state of $100,000 or more, or 200 transactions into the state. That now makes you have what we call economic nexus, and I'll talk more about that. There is yet to be determined an effective date. And so one of the things I've been saying about South Dakota v. Wayfair, a lot of people are really curious about it. Some are very concerned. And in some ways on June 21st, everything changed, and in some ways nothing changed. There was a new ruling, but a lot of states are still trying to figure out what this means to them. How are we going to put this into play in our state? And when are we going to put it into play? So you can see that even though that ruling came down, it's still not effective in the state of South Dakota yet. Just a couple of questions here that we've gotten on this. So some things that you can look for. Again, I mentioned if you're already registered in South Dakota, this decision really doesn't affect you. You're already registered, you're already collecting, you're already paying. Whether or not the thresholds change, it's something that you still need to be on top of. But if you're already a registered tax collector in the state of South Dakota, there's really not a whole lot more to it than that. Does it apply to online transactions only? It can be online or offline transactions, really anybody selling remotely into the state. So even if somebody called you over the phone and they want you to ship it into their home, which happens to be in South Dakota, that is still considered a sale into their state. And does it affect non-taxable transactions? So of course, the taxability of an item doesn't change. So we'll talk about that as well. So only the things that would normally be taxed in the state of South Dakota is what it would apply to. So just a couple of extra details here. I mean, this is kind of a little bit redundant, but I want to point out there's a lot of information around the South Dakota v. Wayfair ruling. Again, I want to just reiterate, I am not a tax expert, but we do have a lot of resources. I'm going to show you a resource page at the end of this slide. One of the great things that we have available to you is a slide on our website, or a page on our website, that will talk about all of the states and what they're looking at doing in terms of the economic nexus levels, in terms of the dollar volume, transaction limit, when they're going to be effective or if they're going to be effective. And we have one of those pages on our website that will list every state, and it's constantly being updated. So I'll give you a resource page at the end of this, and there are also some videos and things like that. And we'll also open it up to questions at the end, but I just kind of wanted to recap a little bit about some of the things regarding South Dakota v. Wayfair, and I'll talk a little bit more about economic nexus as we continue on. So let's just talk about sales tax in general for a minute, though. Let's talk about what sales tax means and some of the compliance challenges. A lot of people, when they think about sales tax, they think about rates. What rate do I need to charge? And if you're the consumer, what rate am I paying? And it's all about the rates. But there are so many more things. This is really just the tip of the iceberg. There are a lot of things that come into play when it comes to a company being tax compliant. So it has to do with nexus, product taxability, jurisdiction assignments, and all of these other things. So it's a much bigger thing than just what is my rate that I should be collecting and what do I need to remit to the state. So I want to talk a little bit about these things as we go through. So there's the idea of nexus. So nexus is really described as kind of the connection between a business and a state, or when you become responsible for collecting and remitting sales tax in that state. It used to really be that it was a physical presence. If you had a building, a brick and mortar building in a state or a location, that now gave you nexus in that state. It kind of changed over time, and there were some rules where maybe if you had a remote employee in a state or something like that, that you could now have nexus. But what's happened over the years is there have become a lot of other factors that states are putting into play where they're saying, you know what, we've decided that if you send an employee into our state for a trade show, you now have nexus in our state. If you now put inventory into a location in a warehouse, even if it's a third-party warehouse, you now have nexus in our state. If you use third-party trucking companies, for example, to carry goods into a neighboring state, like Washington, for example, that could give you nexus in the state of Washington. So the rules have really changed around what gives you nexus in a state. It's not as easy as just saying, well, I have a building in Idaho, and so I have nexus in Idaho and Minnesota. There are so many other things that come into play that could give you nexus in a given state. And once you have nexus, you, again, are required to register, remit, or collect and remit sales tax in that state. So this is just a list of some of the things that could cause you to have nexus. One of the next challenges that we talk about is really product taxability. We talked a little bit about this in the beginning in the pop quiz. What products in each state or jurisdiction are taxable? And I really like to take this a step deeper to any of those of you who actually maintain all of this stuff in your ERP system. You maintain your tax details and your product taxability. You really have to think about how you would begin to set this up in your ERP system as you differentiate things between, again, bagels, are they sliced or whole, or different candy bars. So you'll see some of the same examples here. The snow removal is really important when you get to the winter seasons. But there are over 1,800 different rules, product taxability rules by state that could vary from one state to the next. And it's really, the obligation is on you once you have nexus for understanding which of your products are taxable in which state. The next thing we talk about is the jurisdictional assignments. Many companies and many ERPs, to be honest with you, are using zip codes to do their tax assignments. And zip codes are actually meant to be used by the U.S. Postal Service. They are in no way, shape, or form aligned to taxing jurisdictions. So when tax rules are coming down and there are taxing jurisdictions, there can be many rules that might be just as different as being across the street or in a neighboring community. We have, you see some numbers here, over 150 million mailing addresses, but again, those do not all line up to the same, the zip codes themselves don't line up to our taxing jurisdictions. There are over 11,000 jurisdictional rules. So I want to give you an example of this, and I don't know where all of you are located, but if any of you are located in the Denver area, you may know this already. So we like to use this as an example. This is a little bit of just a quilt map of the Denver area and some of the suburbs. And you can see the zip codes, and a couple of the zip codes we're okay with. 80237 looks like it's pretty much all going to be that 7.35%, because you can see across the bottom we have the tax rate. And 80237 is pretty much all that tax rate. Even 80113 in Inglewood, you can see there is a little corner on the top right that is a different rate. So there are actually, and there's one on the bottom left too, a little light blue. So you can see there are actually 3 rates in that zip code alone. And then if you go down to Greenwood Village, then it just becomes a hot mess, because you've got gray up at the top, you've got green, dark green, light green, and orange, and then the slivers of orange, and there's a really tiny sliver at the bottom of the green. I don't even know if you can see it right here, of orange. And these, again, are where I said it can be as minuscule as somebody across the street having a different tax rate than you. And this can be the difference between 7.72% and 4.35%. This is a 3% swing in getting that tax rate wrong just by having a different address, all in the same zip code. So it's really important that you're making sure that you can manage this really at the address level and not just at the zip code level. I'm going to take this one step further and just show you an example of some of these tax rates. You'll see in 80111, they have all of these different tax rates associated. We've got a football district tax, a Greenwood Village city tax, Englewood city tax, a couple county taxes. So there's a lot of different taxes that come into play just in this one particular county. So understanding your jurisdiction and where each tax rate applies is very important. So then we talk about exemption certificates. We have a lot of customers that talk to us and say, well, we don't collect sales tax, but all of our customers are exempt. And that's great from that perspective. But in that case, you really still should be collecting exemption certificates. And exemption certificates are really just like paper money in some cases. They're actually some of the low-hanging fruit for auditors when they come in. Auditors are likely going to come into your office and say, what is the dollar of your non-taxable sales? Give me that dollar amount. How many vendors make up that dollar amount? And now find me the exemption certificates. And if you can't find valid exemption certificates for those customers, for those sales, they will go ahead and assess you the back tax and fines and penalties. So that piece of paper that you're supposed to collect and be validating could be just like misfiling a check in your system. So there's a lot of risk with not having accurately maintained and stored exemption certificates. So that's part of being tax compliant. And then we talk about state and local tax prep. What does it mean to actually file your returns? Now, this can be very easy for some customers. If you're in one state and you're just filing in one jurisdiction, it might be annually or biannually that you're filing these. So that's not such a big challenge. Where it becomes more challenging is when you have multiple states and multiple jurisdictions. You have to manage that filing calendar. You have to respond to tax notices. What if your filing date changes? Do you have to start prepaying some of your tax once your revenue goes up in those states? So there becomes a lot of management just in filing and preparing for your tax returns at the end of whatever time period is needed. And then the last piece of the audit challenges really just becomes audit readiness, or not the audit challenge, the sales tax compliance is audit readiness, is being prepared when you do have an audit. So that means, do you have access to the information? Can you easily find things like your exemption certificates? How easy is it going to be to pull those reports and validate the information you need? So that is also part of your tax compliant risk, and part of why tax is so tricky for companies, because really more often than not, you don't have people that are hired just to do this kind of thing. It's usually somebody who has a lot of other things on their plate. So it's a lot of information on tax. Let's just take a minute and do a little bit of a mental break. So this is the question in Massachusetts. A clothing item costing up to $175 is exempt from sales tax. However, an item costing $175.01 or above is subject to sales tax. And the answer to this is true. Now, to make this a little bit more complex, in some states, when they do this, it's as soon as you hit that threshold, the entire dollar amount is taxable. In other states, it's only the amount over the threshold that becomes taxable. So again, the rules, just because there's a threshold, the rules aren't even always the same as far as what the threshold is, and then what portion of that do you pay your taxes on. So let's talk a little bit about automation, why you would automate. This is, again, another point in time where I would ask people, how many of you are automating payroll? We like to kind of assimilate ourselves, to that example, because a lot of people are automating payroll. It's not your core competency in your business. It's something that, was just time consuming for somebody to do, but it was necessary. It was a necessary evil. You need to pay your employees. So the same really becomes true with sales tax. There is no upside to this, but it is a necessary evil. So part of the reason why you want to automate is to mitigate the risk, increase your accuracy, and save time by to your employees that are obviously doing other things. But there's a little quote that we have here, which is really great. I mean, any effort spent on sales and use tax compliance and related activities is non-revenue generating. I mean, the reality is all of you are in business for doing something, whether it's services or selling products or, you know, financial services, whatever it may or may not be. I guess it would be something. That's your core competency. Filing and collecting and remitting sales tax is really not your core competency, and there is absolutely no reward for getting it right. Nobody gets a pat on the back, nobody gets a medal. There is no reward for getting it right, but there are a lot of penalties for getting it wrong or not doing it. And so the idea is, if if it's not your core competency, let somebody else take care of that for you. We got a couple stats. These next slides are just really fun figures, and they just talk more about stats. These come from a couple of different studies that have been done. One was by the Wakefield Research Group, and another one was the Aberdeen study. So, and these studies were done by largely accounting and business professionals in a lot of small to medium businesses. So 69% of accounting and finance professionals agree that sales tax is the most confusing part of their job. So they're saying that, yeah, of all the things that I have to do, that is not only the most confusing, but also the least fun. So this next slide is kind of fun. 42% of them would rather get a root canal than go through a sales tax audit. Now, I've had a root canal and I've gone through a sales tax audit. I don't know which I would prefer, but that seems a little extreme that 42% would rather go through a root canal. 48% think that the Rubik's Cube would be easier to master, and I've never ever in my life mastered the Rubik's Cube without peeling the stickers off. So these are just kind of some fun stats. So these are, again, real numbers that come from some research studies that are saying this is very hard, we'd rather not do it. And then I'm going to move into this next slide that says, okay, on top of that, I as a tax or finance professional also believe that if we're audited, there's a 75% chance that they're going to find a mistake. So I'm not even confident that we're doing it right. You know, it's 69% the hardest thing I do, and I'm 75% sure that they're going to find a mistake. And the companies on average are paying somewhere between $67,000 and $400,000. And again, this is just due to different sizes of companies to be compliant. So that's the people in your organization, that's their salary and their benefits, and, you know, taking their pro rata share of what they're spending their time on to do taxes, with researching rates, updating the systems, you know, getting information for audits, filing returns. Companies are spending somewhere in that range to be tax compliant, and they're 75% sure there's going to be a mistake. That just seems very, very risky to me. On top of that, the companies that have gone through an audit have found 56% of those companies have found that a sales tax audit has cost them $50,000 or more. So they're already spending somewhere between $67,000 and $400,000 to be tax compliant. If they get audited, they're going to be spending $50,000 or more on that audit. Now, I want to stress that that is one audit. That is not, you know, be all of the audits in a year. That's on one single audit. And the reason that that's important is once the auditors come in to your business and they have what they deem to be a successful audit, and that's successful by their standards, I'm using air quotes that you can't see. Once the auditors say, we've had a successful audit at ABC company, they're going to come back. They're going to come back again in a couple of years, and they're going to do it again. And the other thing is they may also share that information with other states or other jurisdictions. So now you're going to find that once you go through one audit, you're likely going to go through others. So when we talk about that $50,000 or more, that cost comes from the time of your employees spent preparing and supporting that audit, taking care of the auditor, getting all the things they need. That's obviously the back taxes and the penalties and interest. I do have kind of a fun little story. The very first time I ever went through a sales tax audit, I was pretty young, and my CFO said, when he comes in, I want you to put him in the warehouse at a folding table with a folding chair. And I was just mortified. I thought, what? And, you know, plus I was upstairs and that's downstairs, and I got to run up and down the stairs. So that adds on to that time preparing, right? But he said, listen, we don't want him to be comfortable. We want him to stay as short as possible and get out. And I live in Minnesota, like I said, so we're Minnesota nice. That's really hard. It's really hard to say, here's your folding chair and your folding table in the warehouse. Now have a great day. Oh, and also don't give him a phone. So yeah, that was my experience with taking care of our auditor. So I just want to talk a little bit about how Avalara addresses these. Now, again, I don't know who all's on the phone. Some of you may be already existing customers. Some of you maybe have heard of us. Some of you may never have heard of us. But I do want to talk a little bit about us and our services and how we help address these challenges. So the nexus piece of the sales tax audits, once you have everything set up and you're ready to go in Avalara, when your business expands and you now end up having nexus in another state, maybe because the economic thresholds push you there, or you add an employee in another state, in our system it's as easy as just clicking on that jurisdiction. You simply go into the user portal and you click the jurisdiction. We're already maintaining all of the rates and all of the logic, and we have all of your items mapped. So you just have to click on that state and it's all taken care of. It becomes very easy to manage that nexus piece. The product taxability, we have built-in rules with ongoing updates. We have a team of people who are constantly monitoring all of the states and all of the rules and maintaining all of our cloud operations and our systems to make sure everything is constantly up to date. So you don't have to worry about that beyond a mapping of your items into our rule system during your implementation. The jurisdictional piece, we are using a zip+4. We're doing a rooftop validation of every address. And one of the nice pieces of our product is you actually get an address validation when you use Avalara AvaTax. It does an address validation to make sure that we are using the exact and proper address for that business. So we're giving you the exact rate at that specific address and location. That's an added benefit to any of you that are actually shipping product, because that means you're going to have much better shipping accuracy as well if you don't have some address validation tool in place. But we are using a zip+4 and a rooftop location to make sure we're getting that exact rate for that specific location. We do have a product to automate exemption certificate management, where we can actually go and send the customer a request. We'll validate the information to make sure that it's accurate, that there are the right number of characters. We can manage any expiration dates. So some states do have expiration dates. And the system can also alert you to when certain exemption certificates are expiring and you need to collect a new one. So those become very important. And then state and local tax prep and filing. We do have a product, returns and filing, where we can help with doing all of the returns and filing in your different jurisdictions. You as a user would go in and validate the information, make sure the numbers match to your system, and approve it, and we would take care of all of the returns and filing in those states and jurisdictions. We can also manage any tax notices. So you can have tax notices sent directly to us, and we can manage those tax notices for you as well. And finally, audit readiness. We have, like I said, we'll have a user portal, and I can talk more about that in a second, where you'd be able to go in, all of the information is there. We have dashboards and reporting. Additionally, we have the ability to give your auditors a temporary login. If you want to let them log in and find their own exemption certificates, they can do that, which is going to take time out of your users' hands in the event of an audit, where they can make those auditors kind of self-serve themselves. Self-serve is probably all I needed to say there. So that's kind of how we address some of those challenges. So I just want to reiterate the product offering, because I kind of talked about it a little bit through that, but AvaTax is our primary product. That is the tax calculation product. You'll see that I have kind of a dotted line down to the government. That again is just the fact that our team of people is constantly looking and monitoring at all states' rules and regulations. Internally, we are getting emails almost daily, especially with all of the economic nexus, all the other states that are coming on board and trying to put some thresholds in. We're getting constant alerts to that because our team is researching that and updating our software so that we have all of the latest rates, rules, and boundaries all up to date. And that is going to map to any of your systems. We map to pretty much every ERP, e-com, POS system out there that you can imagine. So if you have a really complex system where you're using an ERP and an e-com system or a POS system, we can really connect to any of those. And what's going to happen is when you enter a sales transaction, it's going to go up and look at your settings in our user portal, and it's going to say, do you, company A, have nexus in that state? If yes, is that customer exempt or not? If no, is that product taxable and what rate? And it's going to send that tax rate back down into your system, and that's all going to take place in about 0.4 of a second. So we're going to go ahead and return those right and proper rates to you directly from our cloud application. It will integrate with our Cert Capture product. Like I said, that's the piece that manages the exemption certificates, where we can request certificates, manage them up in our cloud. Again, validating that information. Excuse me. I don't know how many of you actually know how to validate an exemption certificate. Maybe a lot of you do, but it is making sure that you have the right number of digits on there, that you're validating that it's filled out properly and signed. So our tools will take care of that for you, and it will integrate with AvaTax. So again, when it's asking that question, is that customer exempt or not, it can look there, or it can look at your other system if you just have an exemption box in your ERP, for example. And then the third piece is the returns and filing. So this is the piece where, like I said, we can take care of managing all the returns and filing in your different states and jurisdictions. One of the other pieces that I don't have on here is we do have an entire professional services team that can help with a variety of things. So many of you, if you have a CPA, they'll do a lot of these services as well. But we have a professional services team that can offer things such as a nexus study. It's one of the things that we're really recommending the most right now to our customers who are concerned is to go out and get a nexus study. That basically is having a tax professional look at your business and how and where you're doing business, and then coming back to you and saying, the information that we have tells us that you likely have nexus in these states, and you should be registering or already registered in these states. And our team can help with that as well. We can help with that registration service. So if you need to get registered in a state and don't know how or don't have the time, we can help with that. There is unfortunately a need for some companies to do what we call a VDA, a voluntary disclosure into a state. So voluntary disclosure would be if you found out that you should have already been collecting in a given state and you haven't been doing so. The voluntary disclosure would, you would utilize, again, a tax professional to go to that state on your behalf and say, we have a customer who would like to come clean and get caught up on their taxes and hopefully come to some agreement as to not paying or paying very little back tax or fines or penalties. So again, we have a big team of people that can help with some of those services as well. I do want to mention that anybody who is registered for this, we will be sending out a soft copy of our ebook, Sales and Use Tax for Dummies. It is a book that we co-authored. It's some great nighttime reading if you're looking for something to put you asleep, or if you're really interested in this stuff. It's about 42 to 45 pages that you can look at. So everybody will be getting a complimentary soft copy of this following this webinar. You'll be all receiving that. So I do want to open it up for questions, and I'll give you some time to put some questions in the question box, but also and my contact information is here, so I'll leave this here for a second. And feel free to contact me if you have any questions or comments that you don't want to put in the question box. And then the next slide that I'm going to hop to is going to be on the Wayfair resource page. So I'm going to leave this up here for just another second. And then this is the resource page that I kind of talked about. There's a long URL there. You absolutely can probably go on Google and type in Avalara and Wayfair, and you may get here. I guess I haven't tried that specific Google search, but some things here, there is an FAQ. The Economic Nexus Guide is what I talked about. I realize this is probably very small, but this is the page that I said is constantly being updated. You can see there are effective dates here as far as Connecticut being effective 12/1, at least $250,000 in sales and 200 transactions or retail sales, and there's a little link here. But this is kind of giving you a state-by-state understanding of what each of the states are doing with regard to the economic nexus ruling. And so it's really interesting if you have states that you're concerned about. Some of these are going into play right away. Hawaii was July 1st. Some of them are to be determined, but this page is being updated on a continual basis. So again, you can jot this link down, or I can send it out later, or you can likely do a Google search. So we got through that pretty quickly. I'm going to open it up now. Rebecca, did you get any questions in the question box?
Yes, we do have a few questions. The first one is, when you do a nexus study, what percentage of companies find that they actually have a compliance problem?
It's a great question. I don't know that I personally know like an exact answer on the percentage. I don't know, Clay, if you've heard any answers on that. I'll be honest with you, my gut tells me the answer is probably quite a few. I think that there are quite a few companies that once they do that, realize that there are so many more things that come into play that even they didn't know. And I mean, I know some very, very smart people who are managing their sales tax compliance in their company, but it's just easy to miss things with the rate that they're changing. So I don't know a percentage. If you really want me to get you some more specific answers, I can talk with our services team to kind of get an idea for you. But it's a really great question.
Okay, the next question is, did the court decision cover use tax? Is there not same risk for compliance for use tax with these audit teams? What trends in compliance do you see?
So my understanding, and again, I'm not a tax expert, my understanding is the ruling didn't necessarily cover use tax, but it's a great question because use tax is a part of many audits, and it's actually it's a very important part to many audits because that is in some cases for companies harder to manage than sales tax. I didn't talk about that, but we do have some use tax tools within our connectors as well, where we can integrate with the accounts payable side of the invoice, and users can actually mark whether or not use tax should be applied, and that can right up to the portal. So we do help with use tax as well, but it is a little more tricky because the rules aren't always as hard and fast, and every business is a little bit different. So I don't believe, and again, I can double check, I don't believe that the ruling itself had to do with use tax, but it is still a very, very integral part of any audit that you might go through, because auditors are definitely going to be looking at use tax as well.
Do I have to change any of my current ERP processes to use Avalara?
Yeah, that's a great question too. So the answer to that is no, and the only caveat I make to that is, of course, you're going to have setup. So when you first implement Avalara, you'll do some setup, and you'll change a few things in terms of, instead of using your tax details or your tax schedules, you'll be using AvaTax to make a call up to our service. But your day-to-day process, everything you do within your ERP to enter an order, nothing there will change at all.
When taxability rules or tax boundaries change, do I need to do anything to update my tax schedules?
Nope, absolutely not. So again, we have a team of people who are constantly monitoring that and updating our cloud system. So we will be managing all of the rules, the rates, and the boundaries in our system. So nothing has to take place there. Now I say that, and I want to add one caveat to that though. If your business changes and you now move into another state, and now all of a sudden you have nexus in a neighboring state or a state across the country, we don't know that. So you still would need to at least have some responsibility for that, and making sure that you go in and mark where you have nexus. So if your business changes and carries you into another state, you have to mark that, but you don't have to manage any of the rules or tax boundaries or anything like that. We'll take care of all of it.
Perfect. So that's all of the questions we have at this time. So I want to thank you, Stacy, for the presentation, and thanks everyone for attending, and we hope to see you next time.
Thank you.